How the Rich Protect Their Wealth During Crises, 2025 edition. In 2025, the global financial landscape looks more uncertain than ever. Mounting debt, inflation, geopolitical tensions, and an overinflated tech market have investors on edge. Amid this chaos, the rich are not panicking. They are methodically protecting, and even growing, their wealth. Today, let's explore exactly how the wealthy safeguard their fortunes during turbulent times, and how you can learn from them. Mindset of the wealthy. First and foremost, the rich understand one thing: crises are cyclical. They do not view market downturns as a catastrophe, but as an opportunity. Where average investors panic, sell, and retreat, the wealthy remain calm, patient, and strategic. Their number one principle? Capital preservation first. Growth second. They know that during severe market crashes, sometimes 50% or more, the key is to stay solvent and liquid. Because those who survive the storm, buy assets at a discount, and position correctly, will emerge far wealthier when the cycle turns. Diversification. True diversification. Many talk about diversification, but few practice it correctly. The wealthy diversify across asset classes, geographies, currencies, and even investment styles. Their portfolios are not 80% stocks and 20% bonds. Instead, they spread across cash, short-term government bonds, dividend-paying blue-chip stocks, gold and other precious metals, real estate, income-producing, private equity and venture capital, select crypto assets, global currencies and international markets. Cash is king. Again, for years, cash is trash, was the mantra. Not anymore. Today, high-yield money market funds, short-term treasuries, and cash equivalents pay 4 to 5% or more. The wealthy are increasing their cash reserves to maintain liquidity, ready to pounce on distressed assets during corrections. In a crisis, cash buys freedom, optionality, and the ability to act while others are frozen. Government bonds, selectively. Not all bonds are equal. Wealthy investors favor short-duration government bonds and TIPS, Treasury inflation-protected securities. These instruments preserve capital and purchasing power while reducing portfolio volatility. Dividend stocks. Quality matters in a volatile market. The rich rotate toward high-quality dividend stocks. Companies with consistent cash flows, low debt levels, strong pricing power. Defensive sectors like healthcare, utilities, and consumer staples. Dividends provide steady income, which is reinvested when prices are low, compounding returns. Gold and precious metals. Throughout history, gold has been a hedge against systemic risk. The wealthy allocate 5 to 10% of their portfolios to physical gold, gold ETFs, and sometimes silver or platinum. Why? Because precious metals hold intrinsic value when fiat currencies weaken. They provide protection against inflation and geopolitical upheaval. Real estate. Income-producing assets, not speculative flips, but solid, income-generating real estate. Prime residential rentals, commercial properties with strong tenants, and farmland are favored. In turbulent markets, cash flow from real estate provides stability and a hedge against inflation. Private equity and venture capital. Sophisticated investors seek exposure to private markets, where returns are often less correlated to public equities. They invest in private businesses, venture funds, hedge funds, alternative credit, crypto, strategic allocation. Unlike retail investors chasing hype, the wealthy allocate small percentages, often 1 to 3%, to core crypto assets. Bitcoin, BTC, Ethereum, ETH, stablecoins, USDC, USDT, and they custody assets securely, often using cold storage. They view crypto as a long-term asymmetric bet, not a casino. Global diversification. The rich diversify internationally. Equities in developed and emerging markets, foreign real estate, global currencies, international bonds. Psychology of the rich investor. Perhaps the most powerful advantage the rich possess is emotional discipline. They do not panic during downturns. They do not sell in fear. They do not chase hype in euphoria. They operate by principles, not emotions. They have a long-term investment plan and understanding of market cycles, the patience to hold through volatility, the conviction to buy when others are fearful. Common mistakes of the poor investor. In contrast, here's what the average investor often does in crises. Panic sells near the bottom, chases speculative asset, concentrates too much in one asset class, fails to maintain liquidity, ignores geopolitical risk, lacks a long-term plan, makes emotional decisions. These behaviors destroy wealth. Understanding and avoiding them is critical. How you can apply these lessons. You don't need to be ultra-wealthy to apply these principles. Here's how you can start. Keycap 1. Increase your cash buffer, stay liquid. Keycap 2. Diversify across asset classes. Keycap 3. Own quality, avoid speculative junk. Keycap 4. Include inflation hedges, gold, real estate. Keycap 5. Think globally, not just domestically. Keycap 6. Learn and follow a disciplined investment strategy. Final thoughts. The mindset to build wealth in any market. Remember this. In every crisis, wealth is transferred, from the impatient to the patient, from the emotional to the rational. The rich stay rich because they stay calm, liquid, and strategically positioned. You can do the same. You don't need millions to start, you need the right mindset, knowledge, and discipline. Prepare now. Stay ready. And when the next opportunity comes, you will be the one buying while others panic. Disclaimer. This video is for educational and informational purposes only and does not constitute financial advice. Always do your own research and consult with a qualified financial professional before making investment decisions.